Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next 25 minutes here on Options Guide TV. Well, our earnings trades have been looking good. Let's just be blunt. We had a stretch of some rough market trades. I think we're trying to guess where the market was going to go, and nobody knew where the market was going to go through all the news headlines. And I still think we're in that place. I still think the market is really tough. I think the path of least resistance is to the downside, but every once in a while, you're going to get huge spikes up like we do today. And then we're going to be right back to where we started again. There's still, people are talking, and I guess the market goes up, but trade deals take a while to filter through the system. Don't even know. Shipping has stopped. The ports are slowed down immensely. I don't, how long does it take to recover? Do the trade deals get done? There's still just a ton of news that has to happen. If I were to do anything, I'd be fading the market, at least going out until July. But the VIX is saying no. The VIX is saying we're fine, trading down below 20, which I find is interesting because around the COVID times, it took almost a year. Even though the markets were extremely strong, it was 100% a V-shaped recovery around the COVID times. Obviously, different dynamics, different everything, and trying to figure out the vaccination. Is the whole population going to die? Are they not? Totally different scenario. But the VIX just hung around 20 forever. And today we see the VIX trading at 1925 right now. Surprising to me. Now, we did a VIX trade that I think everybody got out of. I got out of it quite a bit, quite some time ago in my portfolio. But if you want to talk about, you should have sold the farm on that one. That was the May 21st expiration. And we sold, we saw the futures trading right around 28, 29. And that trade, if you're not out of it, you get out of it. You got 9 days remaining. VIX is at 19. The future is trading a little bit north of there. Actually, I'm just going to look at it. Don't go to the screen yet, but let me just tell you where the future is for that May 21st expiration. So if I do anything in the VIX, actually, I'm thinking about getting long the VIX. Maybe we look at that today. Maybe we do. Okay, we got the VIX, the 19s. I got to do the put call parity thing to be able to figure out where it's at. I don't have VIX futures quotes. 18. Yeah, it's right. God, the future is trading, even though it's 9 days away, it's trading right at that 19 level. Oh my gosh. Yeah, it's about 19, maybe 19 and a half. Right where we're at right now. The future isn't even elevated. All right, you know what? Let's look at this. Let's go out. I have a different paper trade today. Take Two Interactive is going to be the underlying that we're going to look at because they're announcing earnings. Got a bearish take on Take Two, but I'm gonna diverge and let's look at the June 18th expiration. So let's go to the screen now. And June 18th is 37 days away. I find it interesting that the future for the May expiration is all the way down to where the actual VIX is trading right now, implying that uncertainty is way. I mean, if we get down to, 17 is about normal. You think this marketplace needs to have no one's like just normal marketplace? I guess. We're up strong today, but man, there's still a lot that's got to shake out. So if we go to the June expiration, just work with me here. And let's see where that is at. All right. So what I quickly do is you scan to see where the VIX is at, where the call and the put are almost the same price. And it's right here, right? So I'm just going to look at the bids. On the 20 strike call, it's $2. On the 20 strike put, it's $1.84, and then it switches, right? The put gets more expensive and the call gets less expensive. So we were talking probably $20, 20 I'd say the future's probably trading right for now for $20.25, right in the middle of these two strikes. Is 222? Yeah, 2.20. So we're only at 20 on the VIX going out to June. Man, I want to get bullish. Almost consider a call option. Let's see where the VVIX is at. 88. Oh my gosh. That's down 7 today. Okay, so this is the VIX of the VIX. I guess there's nothing to be uncertain about anymore. All the world's fine. Trade issues have all gone away. So this is the VIX of the volatility index, the VVIX. This is the volatility of the option cut. This is the VIX on the VIX options. The VIX of the VIX. All the way up to 185. That's the big spike after the trade war started. We're down here, all the way down. Look at that. We're at the lows. Man, it's tempting to just buy premium. I don't know if I've ever done that in the VIX. Just bought a VIX call option outright. You're paying low implied. Earnings season is on the tail end. You get 37 days. Market's at $20.25. You can buy. Look at how little. Like every dollar, you're only going like a dime the whole way up. From 22, it's $1.55 all the way up to 25 strike call, and it's $1.11. Man. Yeah, I think I'm just going to buy a call. I like this. The VIX here. So once again, if everything that I'm saying is a little Greek to you, a little Vega to you, I should say, right? That's the symbol that tracks volatility, and it's not a Greek letter. A little Vega to you, then there's an article in my Twitter handle. It's very easy to find if you look at my articles, called Decoding the VIX. You could probably just put in the search term Decoding the VIX, and it explains that the actual VIX index has I shouldn't say little. It has a lot less to do than you think with where the actual option contracts are at. I only like to trade. I don't like the weeklies. The weeklies are just too illiquid. We did the 9 contract and did well on that trade. I think we made $1. Sold 5 points wide for $1 and made about $1. We do so many trades, I sometimes get confused exactly what we did them for. On June 18th, it's 37 days away. I actually think I want to buy some call premium. Time decay is an issue. So if we go out 37 days, where's the July at? Okay, so I'm going to send this let's put this one down. Do I want to go 150? 22, I feel very confident about that we can at least have a spike, but you don't know where the futures are going to go. I'm going to do the 22. All right, I'm going to keep that. Let's send that to the what if calculator just to store it. And then let's go back and let's look at the July contract. Curious where that's at. 360, 216. Gosh, that's trading up probably close to this too. If we do the 22, that's 233 versus 158. And you get 65 days. Yeah, I don't mind that one either. Maybe we buy one of each. So the 22 strike for the near-term expiration and for the long-term expiration. Now, here's the thing. Here's a reason why you might want to buy the 37 strike, 37-day June 18th contract as opposed to the 65-day July 16th contract. And it has everything to do with the sensitivity to price movement. If you're buying the longer term options and the VIX were to do this, to go back to the chart, boom, this is the VVIX, but to spike up, you might not see the back month future move. So you have it here, the VIX spikes, and the future just kind of hangs in this area. But like I said, that one futures contract, the trade that we did, it was trading up around 29. That would be a big move because you're also going to get a huge move in the VVIX, especially with it being down around 88. Yeah, I like this. There's going to be news headlines. There's no doubt about it. I just think that you're pricing volatility risk way too low. Just because the market's up 2.5%. It's a nice move in the market, but man, it makes that move. It's been making that move more often than usual. Okay, so that's going to be the paper trade. I'm going to put them both in. So what I mean is the 37-day future, the June 18th, might be much more sensitive to a huge spike up in the VIX in the short term as opposed to the July 16th 65-day contract. Time premium is cheap relative. You're going from 37 days out to 65 days. You're paying 233 versus 158. You're getting double. That'd be 70 days, not quite double the time, and you're not paying quite double the price. But I like the contract that I would, if I was just buying one, I would buy the June 18th expiration. I do think that there's going to be news headlines between now and the next 37 days that's going to make the market crash at least 2% at one point in time during the day, maybe more, and the VIX will spike back up above 20, maybe as high as 30. That would be over the next 37 days. Do you think that the VIX index will spike above 30? That's the answer. That's why you would buy this. Now, if you want to reduce your risk a little bit, you can obviously sell a lot of premium, and you get a lot of premium way out of the money. I think I just want to buy it. I might sell something later. Like if we went 10 days and nothing happened, maybe you sell some premium later. But you can buy this 22 strike call, and you can go all the way up to 32 and still get 61 cents. Right now, you're below $1 on the total cost. So that's why I very, 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 very rarely just buy a call outright, only because the premium is so sticky, way out of the money on these option contracts, because a huge spike is such a risk to the market makers that are trading them. They're not going to sell it to you for nothing. Like this option, well, here's a quarter. Like the 50 strike is in play, right? That would be almost a tripling of the stock over the next 37 days if you think of this as a stock, but they're still getting a quarter for it. Why? Because it's possible in the VIX. It's possible for the VIX to triple in a week's time. We just saw it happen not that long ago. So with that said, yeah, I like this play. I like that the VVIX is at a low range, which I really didn't expect that. Oh my gosh. I mean, so here's the VIX index. If we do, let's go out 1,000 days, see where the 200-day moving average is. All right, we'll go out 1,000 days. And that is, wow, we're right at the 200-day moving average in the VIX. We're below the 50-day and obviously below the 20-day, but that would make sense. All the way down. So to me, this is the mean average. This is where the market wants to go to. So if you look at the 200-day moving average in the VIX index, market comes down and touches it. It gets back right to that level. It hangs there, it comes back. If it's hanging anywhere, where it hangs is the 200-day moving average. So to me, what this is saying, now the average has been drawn up, like this is the more usual, right here, right? Look at where that's the 15 level forever. It comes up, starts drifting up, but now we're all the way down. So based off of the 200-day moving average, uncertainty is waned. That simple, right? I mean, that's what they're saying. All right. I'm buying this one right here. The June 18th 37-day VIX. Now let's get into our Netflix trade, which is looking really good. NFLX. This where we went back to the wheel, if you will. Come on. If you have any questions, especially about that VIX trade, please do give me a shout out. Give me a holler. What do you think? What do you think of that trade? So the VIX is down 29 points. Oh, yeah, that's why I went to the chart. And FLX, we were talking about the fact that stocks don't go straight up. There was news about a potential tariff that's kind of waned. I don't know exactly what's going on there, but we saw the market, that news sparked, it just needed a catalyst to start going down. And now we've had 3 down days in Netflix. and that news headline happened to be that there was going to be 100% tariffs on movies that were not made in the U.S., but there's so many layers to that. Just that flippant statement is they got to unpeel so many things. But if you look at this, 1,160 market is down. We sold a credit spread. We talked about 2 of them, but the one that I was most interested in was the 90 cent one. 80. This is 14 cents. Oh, I have it in here already. Let's go back to there. Here it is. One second. Pull out just for a second here. Okay, there we go. Go ahead. Let's go back. So here's our trade. And we would just want to stay the course with this. We got the Netflix right here. Let's send this to the trade ticket. And the market is down. So here's the way we set it all up. We went out to the May 23rd expiration, buying the 1,190 strikes, selling 2 of the 1,200 strikes, and buying 1 of the 1,220 strike, the standard skip strike butterfly. See where the market is at here. We did it for 99 cents. It's already trading for 20 cents. I would put a limit order in. We're out far enough in time on this one that I would just want to take the credit. We put it on for 90 cents. If you can take it off for a dime, so I'd put a limit order in to buy this back at a net credit of, it's a net credit of 22 cents. Okay, so flip that. So if we flip the script, we're going to be selling, we're going to be buying, we're going to be selling. And then it's a debit of 23 cents. So this would be the exiting order or the unwinding order. I would put it in for a dime right now. And I would buy it back at that and make it a good till canceled order. So I would keep that there for right now. If we were closer to the expiration date, I would then let it ride. You'd be a little bit more apt to let it ride. You got a 10-point wide butterfly. It's not horrible in that. The maximum upside is 1,000 points. It's wide enough that if it lands somewhere in the strikes, you'd probably be doing okay. In other words, it's not going to go against you so hard that that you won't have time to get out. If you're too narrow on the strikes, it can just blow through the strikes and never really offer you a reward for the market to come back into this area right around where the precipice is on our mountain, if you will. So if that is the case, I would just close it out. If you did the 90-cent one that goes out to the May 23rd expiration, I would just close the trade out for a dime. Get out of that. We did it on Friday. You made 80 cents on the open. Totally fine. Do the trade. Any other, if you got questions or comments, please let me know. Now, I think I explained that fairly well. But the fact that we're going out to that we got 11 days and Netflix could come roaring back, that's too much time. If we were at the 4-day, the May 16th expiration, which is the trade that we looked at, I would probably just leave it. We brought in a lot less of a net credit. You have 4 days to expiration. This trade would be looking really good right now, and you would kind of hope that it would come back and land right around the 1200 level. But in my mind, we did the May 23rd expiration. That's the one I would have done. 90 cents, got 11 days. Okay. So I'd close it out, take that 90 cents if I can, or it would be 80 cents if we closed it out for a dime. Now, the next trade, and I just want to get bearish on Take-Two Interactive. Overvalued pretty significantly. Take-Two Interactive is. So heading into the earnings report, I want to get bearish. Now, I don't mind implied volatility is pretty big, 76%, but it's not outrageous, right, for a lot of these underlying stocks. So I don't mind just buying a put here. Now, if I'm going to do that, I want to buy a little bit of extrinsic or intrinsic value if I can. So I would probably look to go a little bit in the money here. You're going to get a little bit of benefit, or if you pay for the at the money, I guess you're okay. But the company is announcing on the 15th before the market open. So we're talking about Thursday before the open. So you could wait and you could set up this trade till that day. But with that said, I don't mind buying this right now because we could potentially get out of the trade heading in. The market's up strong. Take-Two is down $1. I don't mind buying this and maybe getting out on Thursday. And that's why I'm proposing it now. And I'm going to go a little bit in the money. Now, if we get to Wednesday and the market hasn't moved, we could sell a put against it. But for right now, I have a feeling the path of least resistance going into earnings is going to be to the downside. So I'm going to spend a little bit of money thinking that implied volatility will go up when we get to Wednesday, which will be the next edition of Options Guide TV. Make sure to set your calendars. We can then look at selling a put option further out of a money against that position. All right, so we'll get a little bit more premium because vol will go up, gives us a couple of days to just see what happens, and then we sell the put option against it. So here we go. I'm going to buy this 230 strike put. We're going to be paying half of that is time value and volatility, and half of that is in extrinsic value. So it's not a bad ratio. In that instance, we're getting a delta right around 60. So if the stock goes down one, we would expect this option contract to go up by at least 60 cents. And then we're going to go out of the money going into that earnings report on Thursday morning. In this instance, we'd probably sell either the 210 or the 215. You can get $3 for that, and that's 10 points down. So 215 is pretty enticing. But I really want to get negative on it, so I would probably sell the 210. And you could just do that right now if you wanted to. But to start with, we're going to get fancy. We're going to buy in the money put heading into earnings, anticipating that Take-Two could go down before we get to earnings. And if it doesn't go down and we don't decide to sell it on Wednesday, we will then sell an out of the money put against the position and ride it through the earnings date. That's our plan. All right. Now, if the market did go up, you could just say, oh, well, I'm going to abort this. I'm going to, if I lose half of this premium, I'm out. So that would be my risk on the upside that I would be looking to do. But I'm going to put this together. Okay. 965. We're buying that put option. We're going to send this to the what if calculator. 230 strike, saying $10 right now. I would put it in. I think 975 would be feasible. I don't think we have to pay, we don't even have to pay 10. Let's say 970. Okay, boom, screenshot. That's going to be our trade. That's the paper trade for this week. And it's fun. I like to target earnings for calls. There's and I kind of got to this scenario in a weird way, in that I was always doing it with time spreads, where you're like, oh, they're going to announce earnings. Let's make a forecast on it and either use calls or puts. If we're bearish, calls if we're bullish, and let's buy the call or put option that contains the earnings, expires after the earnings date, and let's sell the option contract that expires before. It's counterintuitive in that you're paying up for implied volatility on the one that you bought, and you're selling lower implied volatility on the one that you sold. But implied volatility is probably going to increase on the option contracts that expire after the earnings, and it's probably going to decrease on the one that is going to expire before earnings. Not to mention you have time value erosion that's greater on the shorter term option. So I always liked that strategy. And then I said, well, why am I doing the time spread? Why don't we just buy the call or the put and get out of it before earnings? And that's what we're going to attempt here on take two. So once again, just like as always on Options Guide TV, they're not meant to be recommendations. We're trying to learn. I was going to just look at Take Two Interactive on Wednesday ahead of earnings. But then I thought to myself, well, you know what? We're fairly negative on it. It's a really overvalued stock. Why don't we just ride it into earnings and see if it's down? And then when I woke up this morning and saw that the VIX is down to 19, the SPX is up 2.5%, and you got Take Two Interactive is down $1, down 0.5% on a very strong market. Yeah, it's leaning negative. And that's what we're going to do. All right, that's it for this edition of Options Guide TV. We'll see you this Wednesday to see what happens with Take Two Interactive, and then we'll maybe leg that into a bear put spread. And 11 a.m. Eastern Time, come to the hub. Check us out, hub.tradier.com. See all the speakers in a nice little format. It's free to sign up. Just put in your email, and you'll get access to all the videos, all the archives, and all the speakers. Thanks for stopping in. We'll see you this Wednesday for the next edition of Options Guide TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.